In the book Richer, Wiser, Happier, author William Green introduces the world to a Nick Sleep that we've never seen before. Nick Sleep and Case Sicaria ran nomad partnerships, and they've recently been lauded heavily by Mohnish Pabrai. They were majorly responsible for Pabrai's change to a focus on long-term compounders over finding 50-cent dollars. There are so many invaluable lessons in this chapter. This is probably the best chapter in this book, so let's dig in to see what Nick Sleep can teach us about investing and how to live. Nomad Partnerships was run unlike most other operations on Wall Street. It was a low-budget affair with the main goal of providing value for the investors in the fund, whereas most funds focus on growing their assets under management as much as possible in order to capitalize on the fees from that structure. Nomad simply wanted to do one thing: turn $1 into $10. They wanted to look back at age 80 and think that they provided the most value for their investors, not that they had 4 houses and 4 private jets. So their purpose from the get-go was providing value for their investors, not amassing as much money as possible for themselves. Green terms this as a house built on rock. So with the Nomad Partnerships, they were trying to build something of permanence. They didn't want to track against some benchmark on relative terms. They wanted their absolute returns to trounce any other competition. They closed up shop after 13 years with a staggering 921% return before fees, just shy of their goal of turning $1 into $10. So the fund's annualized return before fees was 20.8%. After fees, it was 18.4%. We can compare that to the 6.5% that the MSCI World Index returned over that period. When Sleep and Sicaria were researching companies, they asked questions that had a long shelf life. What is the intended destination for the business in 10 or 20 years? What must management be doing today to raise the probability of arriving at that destination? And what could prevent this company from reaching such a favorable destination? Nick Sleep called this approach destination analysis. I made a video you can see over here where Pabrai talks about this mental model that he learned from Nick Sleep recently. To discern whether or not a company is going to be a good investment today, it's really helpful to, as Charlie Munger always says, invert, always invert. So if we start with the destination that we prefer in, say, 10 or 20 years, what must happen from now until then in order for that company to reach that destination? And on the other hand, Sleep recognized that Wall Street in general was obsessed with short-term results. The main things that they cared about were the earnings for the next 3 quarters or the next 3 years even. But what's most important is how that business performs over the next decade, 2 decades. What is that business doing today that's going to prevent it from reaching its desirable possible destination in the future? For example, are they known for treating their customers or their suppliers with disdain and disrespect? Do they offer the lowest quality products with the highest price? Are they ridiculed for their service? These are some of the questions we can ask to discover whether or not a company is going to reach its optimal destination down the line. Sleep and Sicaria operated Nomad Partnership with the highest of quality. Sleep was deeply influenced by Robert Pirsig's book, Zen in the Art of Motorcycle Maintenance. The main thrust of that book is that we act with quality in all of our actions, and that's exactly how they ran Nomad Partnership. But above all, probably the single most important trait for Nick Sleep was his idiosyncratic mind. There was a lesson from Sir John Templeton that described the idea of a non-tribal investor, and I believe that Nick Sleep, and probably everybody else covered in this book, falls directly under that category. Not only did Sleep have the unusual ability to have high conviction in bets that were potentially contrarian, but he cared more about things such as the quality of the decisions and the quality of the way you operate versus just amassing money, which is the typical behavior for hedge funds. Again, he echoes Robert Pirsig's book by saying that you really want to do everything with quality because that's where the satisfaction is. The real cycle you're working on is a cycle called yourself. The machine that appears to be out there and the person that appears to be in here are not 2 separate things. They grow toward quality or fall away from quality together. So these were the types of ideas that Nick Sleep was thinking about when he was investing, not how can I squeeze my clients for another $1 million? Just like Mohnish Pabrai and Warren Buffett, Nomad Partnership's fee structure was very favorable for investors. They charged a tiny management fee just to cover the expenses of keeping the operation going. Typically, an asset manager will either charge 1% or 2% of assets under management on top of a 20% performance fee. Nomad Partnership charged a 25% performance fee, but only after they had achieved a 6% return which was a high watermark return. So if they lost money in a year, they had to get back up to that 6% mark before they could start collecting fees. In the past, Mohnish Pabrai has talked about this fee structure and how basically for many, many years, he had been living on fresh air and water fee-wise. So it only makes sense that when a manager underperforms, the clients shouldn't have to pay for that underperformance. William Green says that they practice the art of intentional disconnection. It's so common for investors to be looking for that next hit of dopamine, always looking at their screen, always looking at their stocks. Their portfolio rules their lives. Not only does this type of behavior keep you distracted, but it also doesn't provide very much valuable information for how a business is going to perform over the next 10 or 20 years. This type of behavior focuses on the near term, when what we really should care about is how the company is going to perform in the long term. Nick Sleep calls this wiggle guessing, trying to predict the short-term movements in the company's stock price. In addition, shutting out all the noise from Wall Street helped Nick Sleep remain committed to his high conviction in his own thoughts. It's so easy to get distracted and manipulated by outside information, so the best way to go about your business is simply to shut it all off. They do have a Bloomberg terminal, but it sits at a desk that they never go by, and there's not even a chair at that desk. Sleep wanted to spend as few moments behind that screen as possible. As we talked about before, it's more important to think about the business's performance, not the stock performance. Sleep compares information to food. He says that all of it has a sell-by date, but some of it has a lot longer shelf life than the others. They don't believe that you can predict how the economy is going to unfold, so why even pay attention to that? The news is going to report sensationalist information, and it's their job as investors to ignore that information as much as possible. So for us as investors, it's really important, according to Sleep, to dismiss anything that is short-term oriented. We shouldn't care about what the next quarter's earnings per share are going to be projected at. He says you need to be wired not to believe the bullshit, to not be listening. So they avoided the general gossip of the news cycle, and they didn't read sell-side analysis from Wall Street or anything like that. They came to their own conclusions. Both of the managers of Nomad Partnerships came from untraditional finance backgrounds. Sleep actually imagined himself as being a landscape architect. Once he realized that he'd be designing more windows than actual gardens, he decided to switch his tune. He read a book called Investment Trusts Explained, and that made him kind of interested in looking into investing. So he got an apprenticeship. He said he liked the idea of it being an intellectual investigation. Warren Buffett has said many times that if he weren't an investor, he would probably want to be a journalist. And a lot of the times we can think of investing as journalism because you're basically trying to create a story around a company to determine what that company will look like now and what it's going to look like in 10 or 20 years from now. So Sleep ended up getting a job for a small investment firm, and that's where he really cut his teeth learning how to invest. One thing I want to point out about Sleep's past is that really there was no sign that he was going to be an outstanding investor. He had a relatively typical past. He studied geography in college. He worked at Harrods department store and a small IT firm. Nothing that really gave the indication that he was interested in investing at all. So he wasn't some prodigy like Warren Buffett. He didn't buy his first stock at the age of 10. Nothing like that. Zakaria too grew up having a deep mistrust of Wall Street and investing based on some experiences he had watching his father's family business. Basically, Zakaria's father had bet away his fortune on some sort of pyramid scheme in the stock market, and that left Zakaria forever scarred about how Wall Street operates. Eventually, Sleep and Zakaria started working together, and in 2001, they founded Nomad Partnerships together. They started Nomad in part to retaliate against what Sleep calls the sin and folly of the traditional Wall Street hedge funds. And after experiencing the boom and bust of the dot-com bubble in the late 1990s, they realized there's got to be a better way to do this thing. Now at the start, like most investors, including Mohnish Pabrai and Warren Buffett, they looked for the crazy cheap bargains at the bottom of the discount barrel. As I said before, their main goal was to increase the value of their assets under management tenfold. And it's a foundational piece that seems to be key to the success of Nomad Partnerships. Favoring returns over assets is one of the key characteristics of most of the great investors that I follow, including Warren Buffett, Mohnish Pabrai, and Charlie Munger, for instance. Buffett always says that you could be on a deserted island surrounded by shark-infested waters, and people will come and find you to give you their money if the returns are good. In fact, Nomad Partnership closed their fund several times to new money. Hopefully this illustrates the idiosyncratic nature of this partnership. They didn't want to accept any more money unless they had a great idea where they would be able to deploy that capital effectively. But let me tell you, they definitely found some opportunities to deploy that capital. I mentioned before that they started their partnership investigating companies that maybe weren't the greatest companies in the world, but were irrationally cheap. For example, in the Philippines, they invested in Union Cement after their share price plunged from 30 cents per share to 2 cents per share. The company at the time was selling for 1/4 of the replacement cost of their assets. They bought a newspaper publisher that was trading for less than 1x its revenue, and they weren't afraid to go to unusual places that most investors aren't willing to tread. Again, they struck gold when they bought into a Zimbabwean cement producer, where the company was selling for 1/70th of the replacement cost of their assets. So these were extremely deep value cigar butt, Benjamin Graham style companies, where you get one last puff. Again, this was another contrarian bet, another sign that they were trying to buck the trends of typical Wall Street behavior. Sleep wrote in his letters that the clients will hate it, compliance will hate it, the consultants will hate it, marketing will hate it, the size of the investment opportunity is tiny, it is not part of the benchmark, it's perfect. Oh, and they sold out of that business in 2013, and they made as much as 8 times their money on the sale. But as we see with many investors as they begin to evolve in their investing journey, you realize that perhaps this cigar butt approach is not as sustainable or profitable as other approaches. Because once that company reaches fair market value and you sell it, then you have to find another opportunity to put that money somewhere. So the obvious answer for them was to buy into the best, highest quality companies that were likely to compound for many years. One of the earliest experiences they had when learning this lesson was in 2002 when they bought into a popular stagecoach company. Stagecoach was a British bus operator that had basically taken on too much debt and tried to expand way too fast. Sleep got interested when the stock crashed from about 2.85 pounds per share to about 14 pounds per share. He said that it could easily be worth 60p. This was a typical turnaround situation where the original founder was coming out of retirement to try to correct the ship. The main goal was to basically just streamline the business and focus on the bus operation, the core of the business. Eventually, the turnaround worked, and Sleep made 6x on his investment, patted himself on the back, and moved on to other opportunities. But the hard lesson came when, in 2007, the stock price increased to 3.68 pounds per share. Sleep said that he and Zakaria felt a bit like horses' asses because they had only ever framed the company as a cigar butt. But what he misunderstood about the opportunity was the ability of management to rationally allocate capital to grow the business for a long time. He says that if management is thinking rationally and long-term oriented about capital allocation, then you can subcontract that job to the management of that company, and you don't need to worry about buying or selling shares. This led them to explore the characteristics of businesses that, as they framed it, had long shelf lives. And then this is one of the biggest lessons that I learned from this chapter on Nomad partnerships. That's the business mental model of scale economies shared. For Nomad, this turned out to be the most powerful discovery of their careers. In 2002, the share price of Costco dropped from $55 per share to $30 per share. The market was worried about their low margins, but Nick Sleep and Zakaria saw right through that. The market was missing that Costco was fanatical about providing value and the lowest cost to their customers. There was an annual membership that kept their customers coming back to the stores, and they were reliably known for providing a reliable stock of the lowest priced goods. Typically, goods are marked up at least 30%, but Costco never marks up their merchandise more than 15%. The main key here is that Costco valued the trust of its customers more than increasing the size of its margins. In turn, customers continue to return to Costco stores and spend money with Costco. So from the increased customer interaction, Costco began to grow and it was able to renegotiate prices with suppliers, and that in turn reduced the prices at Costco. This led to a virtuous cycle between Costco and its customers. Sleep says that increased revenues begets scale savings, begets lower costs, begets lower prices, begets increased revenues. So it was just one big rotating virtuous cycle for Costco and its customers. Costco kept providing value and the customers kept receiving value, spending more money. Costco lowered its prices and gave more value and incentive for the customers to return to Costco. And the thing about Costco is they have never wavered on this stance. So even to this day, that is the MO for the company. So as long as that stays intact, Costco is going to be indomitable in the retail business. I think Sleep and Zakaria have both owned Costco for about 18 years, and in that time, the share price has gone from $30 to $380 per share, all while paying dividends. And at one point, it accounted for 1/6 of Nomad's total portfolio. Eventually, they discovered this pattern in a bunch of other companies. They noticed it in Walmart, in Dell Computers, in Southwest Airlines. All of these companies passed on their savings back to the customers, and the customers continued to love to shop with those companies. And Sleep himself admits that it's not a new mental model. Henry Ford was able to do this with the Model T, where they were able to reduce production costs and then turn were able to reduce the cost of the Model T. So with them, we see a shift from buying cigar butts in their portfolios to a highly concentrated effort to buy large shares of these long-term compounder companies that use the strategy of scaled economies shared. He even goes as far to say that it was probably the single best idea he's had in his life, and it makes all the other ideas that he's had pale in comparison. The best investment for Nomad Partnerships was, of course, Amazon. Jeff Bezos was almost like a kindred spirit to Nick Sleep and Zakaria. He was a contrarian businessman, willing to go against the grain in order to do what he thought was best for his business in the right way. One of the main factors that they realized about the power of Amazon was Bezos's extreme focus on keeping costs as low as possible and continuing to cut costs on the products that they sold. Amazon was following in the exact same steps as Costco. He was investing hundreds of millions of dollars back into the business, and this turned off a lot of people on Wall Street, thinking that they were just not making a profit, they were never going to be a profitable company. But really what Bezos was doing was trying to capture the value of customers who love Amazon and love using Amazon. He wanted to return any sort of efficiencies that he was able to invest in and give that value back to the customer, because in that way, you're very sticky with the customer. At an early stage, it might have been really hard to see how Amazon was going to be very valuable in the future. But if you had this mental model, like Nick Sleep, you may have been able to spot this opportunity. He saw Amazon unveil the Amazon Prime membership, and a light bulb went off in his head saying, oh my God, I know exactly what's going on here. This is just like Costco's annual membership. It's recurring revenue from customers that love to shop here. He concentrated so heavily in this stock, I think he put about 20% of the assets up front into Amazon, that about a quarter of his clients left the partnership. His extreme approach to this concentrated effort turned off a lot of his investors, but he knew he was right. And the price did drop dramatically at one point, and he almost felt like he needed to throw in the towel. In 2008, Amazon dropped by almost 50%, but instead of giving up and selling Amazon, he doubled down on his conviction and filled up his portfolio with other great businesses like Costco and Berkshire Hathaway. And then from 2009 to 2013, Nomad returned over 400%. So as we can see, here's another example of having a strong conviction in your own ideas and an assessment and analysis of a business. And additionally, this is a great example of why money in the stock market is not made in the buying or the selling, but it's in the waiting. If Sleep had cracked and sold in 2008 and wrapped up the partnership then, his record would not be very good. But he held on to his conviction. The saga in Amazon is a big lesson in the value and power of scale economies shared, in the ability to stick with your conviction even when everybody else thinks you're wrong. In 2020, Nick Sleep did end up selling 50% of his Amazon holding, but it remains to be seen whether or not that sale is going to be a mistake. He said he hated it and it felt terrible to sell it, so I hope he doesn't regret it. Now that they both just managed their own money, Zakaria also says that one technique he uses is, what would Nick do? He asks that question, what would Nick do? And more than likely, the answer that he comes to is, I wouldn't do anything. I wouldn't sell this. So he just puts it away for another 6 months and comes back to it later. So maybe we can add that to our checklist. What would Nick Sleep do? What would Warren Buffett do? What would Charlie Munger do in this situation? William Green provides a good summary for 5 lessons that we can take away from Nick Sleep. The first lesson is that as investors, we should pursue quality above all else. This is the lesson that Sleep learned from Zen in the Art of Motorcycle Maintenance. If you add this as one of your mental filters, you'll probably end up making a lot better decisions than compromising on the morality and the quality of what you do. Secondly, we can focus on the ideas and information that have the longest shelf life. Nick Sleep goes on at length in this chapter about the importance of ignoring things with a short-term view. As with his best investments in Costco, Amazon, Berkshire Hathaway, all that mattered was the possible destination for where that business was going to be 20 years down the line. Thirdly, don't forget the mental model of scaled economies shared. When you notice a company is feverishly lowering their prices and passing that savings onto the customer, and then the customer keeps returning to that business, you might be onto a wonderful business. It's possible that we may have never have heard of Nick Sleep if he hadn't discovered this mental model and applied it. Amazon is by far his best investment, and he took this one mental model very seriously and applied it to Costco and Amazon, and it paid off wonderfully for him. So it goes back to that saying, take a simple idea and take it seriously. The fourth idea is that we don't need to act in an immoral or unscrupulous way in order to get ahead, especially in investing. Typical behavior is self-serving, me first type of attitude. But I would ask myself this question: when I'm 80 years old, am I gonna look back at myself and be proud of what I've done? And this ties sort of in hand with the idea that we should try to get as much quality out of our actions as possible. So basically, you don't need to act like a piece of shit to get ahead. And fifth and finally is a lesson that we can all relate to. And that is that focusing on the short-term instant gratification way of living is not going to get you anywhere in life. Investors with the ability to focus, especially on long-term outcomes, have a big advantage over other investors. As a small-time investor myself, I know that I have advantages in both the opportunity set of companies that I can invest in, but in also the time horizon and patience that I know other investors don't have. So it's super important to have a pretty strong conviction in the ideas so that you don't need to look at your portfolio every hour of every day. Turn off the notifications on your phone and go about your work. Just do a lot of reading and thinking, like Warren Buffett and Charlie always recommend. If you're able to delay your gratification, there's almost no way that you won't end up very wealthy if you're compounding at anywhere even slightly better than average. We want to avoid making investment choices as often as possible because, as we know, the best investors are the entrepreneurs who never sell their businesses, such as Jeff Bezos, Sam Walton, and people like that. There's so much more to learn about Nick Sleep, and if you haven't bought Richer, Wiser, Happier by now, you should definitely pick it up. It is one of the best investing books that I've read in a long time. Seriously focus on this chapter by Nick Sleep. You'll come away being a better investor, guaranteed. If you like this video, you might like my video over here where I talk about what Mohnish Pabrai has learned from Nick Sleep. Otherwise, please like the video and subscribe to the channel if you want to stay up to date with my other videos in this series covering Richer, Wiser, Happier. Thank you so much for your time. I really appreciate you watching this all the way to the end, and I will see you in the next video. What did you do during the war? I turned 1 pound into 10 pounds.